Ladies and gentlemen, good day and welcome to the Bata India Limited earnings conference call hosted by Batliwala & Karani Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Nikita Jain from Batliwala & Karani Securities India Private Limited. Thank you and over to you, ma'am.
Thank you, Yusuf. Good afternoon, participants. On behalf of B&K Securities, I would like to thank the management for giving us the opportunity to host the Q3 FY23 earnings call. Today we have with us from the management, the MD and CEO, Mr. Gunjan Shah, Director, Mr. Shaibal Sinha, and the Company Secretary, Mr. Nitin Bagaria. I would now request Mr. Nitin Bagaria to start the call with his opening remarks, post which the moderator will open the floor for Q&A. Thank you and over to you, Nitin.
Thank you, B&K team, and welcome everyone. Good afternoon to all of you. I have with me Mr. Gunjan Shah, who is MD and CEO, and Mr. Shaibal Sinha. We will directly jump into the presentation that has already been shared with the stock exchanges. We assume that you had gone through the same. We will navigate through the slides as well as the page numbers so that we stay synchronized. On the slide number 2, we have the disclaimer. I'm sure you have gone through the same. I now request Gunjan to take us through the presentation. Then we can do the Q&A round. Thanks and over to you, Gunjan.
Thank you, Nitin. Hi, everyone. Good afternoon, ladies and gentlemen. I will jump into the presentation, which is starting with slide number 7. Quick update on the few levers that we have been talking for some time. Sneakerization on portfolio. I think there has been significant movement forward in terms of newness. Highlights being sneakerization continues to lead our growth by a good margin. Obviously, we are trying to bring in many more styles, especially in terms of pop colors as well as whites, depending on the store cohorts, etc., as we penetrate them and see success in it. The other piece that I will also talk about a little down the line, but is floats, which is our washable specialty comfort compound footwear, which continues to show great momentum. It is now penetrated to almost 80% of our network and is at an annualized run rate of almost something like 60 crores already. It's a product that was launched almost about 18 months back. On expansion, franchise stores saw significant expansion and movement forward, as I had even spoken last time to you all, and this quarter saw largest addition in our history, and we are hopeful that with the kind of momentum and the profitability we are seeing in this channel, we'll keep pushing this lever and the kind of possibility or opportunity that is there in the various markets across India, across pop strata. Distribution business, we also saw expansion in terms of distributors, while that business and especially the mass categories have been under some amount of stress for the last 3-4 months. But our fundamentals still continue, both in terms of town expansion as well as in terms of the right kind of distributors giving us access to potential. And with hopefully the inflation subsiding, we should start seeing that momentum coming back to us. On the marketing investments, we continue to invest. This quarter saw a significant investment towards basically the festive season, driven by our wedding portfolio as well as festive occasions. The campaign was run behind it, and we also saw the start of a sneaker campaign that is in full flow right now. This is also backed by a continuous improvement that we see in the net promoter scores of consumers who interact with us in our stores. That has now reached almost 75+. We keep plugging at it. The gold standard on that stays in mid-80s, and that's where we want to go. On the digital footprint, there also, while it continues to lead growth, it is a double-digit contribution despite normalization and offline now significantly picking up. Large improvements that we see is basically in terms of our Bata.in e-store of ours, and that is now reaching a significant higher number of repeat customer usage. and therefore much better realizations. Sneaker contribution is even higher, almost to 1/3 of our business that we do on Bata.in, and tells us therefore the kind of potential that is there. This has been also backed by significant improvements that we saw in terms of the consumer service that we do on Bata.in. Agile, efficient supply chain. This is one big lever that has been taking some time for us to get into action. We see now momentum coming through. One large piece that we went through during this quarter is our largest warehouse. Out of the 4 retail warehouses, has now gone into 3PL. Hopefully will give us efficiencies as we go by, and nimbleness in terms of manpower. Continuing on that lines, flexi manpower, I've talked about this, and this continues with great momentum, now close to almost 15 to 18%, depending on the month, is now flexi manpower in retail. That allows us to have much better manning required during the high footfall time zones, while simultaneously maintaining the cost under control. Last but not the least, we do continue improving in terms of our technology. 2 large projects got undertaken during this quarter, and which is the ERP project as well as HPM. HPM for you all is basically high performance merchandising. With the large store network, it's very important that we build a science into the way we do merchandising for different cohorts. And while this will help us basically automate the entire thing, and an end-to-end, right from forecasting to replenishment of stores will get automated through this. HPM will go live by mid of this year, that is 2023 around June, and ERP is scheduled to go live in another 9 months from now. Moving forward to the next chart, which is page number 9. Page number 9. Our expansion footprint continues, while the milestone that you see of overall 2,000 hit. I think franchise I've spoken about, the shop and shop and franchise are the efficient flexi channels. They continue to expand. Coco, while you see a net addition of 1, as I had mentioned a couple of quarters back, we are now into net additions. This quarter we saw a little more muted net additions. We will want to see, as I have mentioned, a 20-80 ratio in terms of Coco versus franchise EBO expansion. This quarter we saw also a significant action on some low profitability / low value adding stores to us, and that is why the net store addition stands at 1. We are hopeful that we should again start seeing significant additions, just like last quarter was about 10. Renovation, which drives same-store growth, is something that continues, and that is continuing to provide us momentum. We saw about 35 stores undergo renovation. I have not been able to share a chart while there are some highlights out here on certain key categories, but I'll at least comment on it. Sneakers continue to grow faster than the overall business by almost something like 20 percentage points. Hush Puppies, the premiums portfolio of ours, at an overall level grew again almost something like 20 percentage points, and with the exclusive Hush Puppies concept growing at almost something like 30 percentage points. Comfort, also a brand of ours which has been continuously giving us great legs over several years, also grew significantly at about 22%. And floats I've already mentioned, while the base is negligible because it was a new product, but now contributes, as I said, as an annualized run rate of almost 60 crores. We plan to take it up to hopefully 100 crores this year, and it had a sequential jump of 20%. So basically the premium and obviously the new collection was driving our growth from a category perspective. As I mentioned, mass categories have some kind of sluggishness in terms of demand, with the kind of hit that they have taken in terms of GST as well as inflation that has impacted on that side. As that cycles back, we hope to see that momentum coming back. In that breadth, as I mentioned, in the distribution business of ours, we continue to make sure that the right levers and the platforms continue, whether it be in terms of footprint and whether it be in terms of categories. Our core categories still continue to grow. However, we want to see the overall momentum at the price point less than 1,000 coming back sooner rather than later. On the digital side, penetration continues. I think a seasonal movement, but overall growth continue to outpace. Even this quarter, it continued to grow fast. And I mentioned while sneakers does extremely well on overall e-commerce, in Bata.in has obviously grown by almost 100-200%. but in overall e-commerce also grows by about 42%. Women's category, so now we are trying to get into much more customized merchandise in e-commerce, as well as making sure that we are able to have the right price points that we want to plug out there. On campaigns, we ran multiple campaigns run across wedding occasions, the festive, as well as sneakers, and I think that does result in basically us getting the same store growth into our stores. Moving towards the next slide, which is number 14, highlights, some of them I mentioned, NPS moves, human resource, we have implemented SAP, so technology is getting embedded in many ways. ERP, we are going ahead, I have talked about it, we go live in another 9 months. The project is on track, there's an exclusive team that has been manned behind it. High performance merchandising shall give us significant benefits, not only in terms of better productivity of the merchandise put up in stores, but also in terms of the kind of turns and inventory productivity that we get. Flexi manpower I've talked about. We do see now a good amount of benefits coming through, while we saw some of it flowing into this quarter in terms of margin benefits on efficiencies, which are structural, as well as taking benefits of some of the material price changes that we see. There are some stabilization that we see in material price inflation, and maybe in a couple of categories, some kind of a slight decline that we see as of now. We also obviously enhance capacities where required from a warehouse perspective, etc., besides taking it on a 3PL movement in the largest warehouse that I mentioned. The last chart obviously shows you the financial summary, right? Well evident to you. We see basically the revenue at 7% versus last year, and obviously a 2-year because that's a COVID base. We see EBITDA moving obviously much faster than the PAT, and that is because we had interest income which is lower because of the dividend payout that we have done. Right. A small mention, we had a VRS payout during this quarter, and in one of our factories that should hopefully help us in terms of better efficiencies going forward. So thank you. That covers the presentation. Thank you so much.
Thank you. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for first question is from the line of Mr. Bhargav Budhava from Kotak Mutual Fund. Please go ahead.
Yeah, good afternoon team, and thank you for the opportunity. Sir, you alluded to the fact that there was some weakness being seen.
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया लाईनवरच राहा. The person you are speaking with has put your call on hold. Please stay on the line. आप जिस व्यक्ति से बात कर
Hello.
Sorry for the disturbance. Mr. Bhargav, please go ahead.
Yeah. Sir, my first question is that in your opening remarks, you alluded to the fact that there has been some weakness on the mass side of the portfolio. So is it possible to sort of split your revenue into how have you done on the below 500 MRP segment and above 500 MRP segment?
Sorry to interrupt, Mr. Bhargav. It seems that we have lost the line of the management. Please stay connected while we reconnect to the management. Ladies and gentlemen, the line of the management has been connected.
Yeah, should I go ahead?
Yes,
Yeah,
Mr.
please.
Bhargav,
What
please
was
go
the
ahead.
question?
Yeah. Sir, in your opening remarks, you did mention that there was some weakness on the mass side of the portfolio. So is it possible to cut your revenues into how it has performed on the below MRP or 500 and above 500 MRP? How has been the performance?
We could get your name.
This is Bhargav from Kotak.
Thank you, ma'am.
Okay. Hi, Bhargav. Yeah, we'll try and give you some indication of it because we do have also, we do changeovers across seasons in terms of various articles, etc. But a price point wine analysis shows that basically less than 1,000 and within that less than 500 and 500 to 1,000 has actually seen the decline from a contribution perspective by almost about 10 percentage points. Obviously made up by the greater than 1,000. Greater than 2,000 is the one that's grown the fastest. Another way of giving you an indication is obviously our brands. The ones that I talked about, sneakers and ASP of about 2,000 rupees. Hush Puppies ASP is about 4,000. Your floats is an ASP of about 1,400 and Comfort is an ASP of about 2,100. So these are the ones that you could see very clearly how they have grown, and that shows up in terms of the same phenomenon that I talked about from a price point perspective.
And sir, what would be in terms of contribution of the less than 500 MRP portfolio for us? Would it be very large?
Less than 500 would be roughly around 25%, I would say, about 22% now.
Okay, understood. Secondly, sir, you mentioned about the ERP implementation in the next 9 months you expect to go live. So the last time we did this implementation, obviously the experience wasn't that great. So is it fair to say that this time around we've plugged those loopholes? And also if you could share who's the software partner?
No, absolutely. In fact, even everyone involved, whether it's the global management as well as the India board, all of us in the management, etc., have been very cognizant and aware of this entire piece that happened a few years back, right? Obviously, in a very different context, in a very different structure, etc. So, as I said, many learnings that have been obviously understood and incorporated. One of the largest pieces for sure is to make sure that two large things to indicate to you. One is that we have created an exclusive team structure to make sure that there is a dedicated focus that is there towards the entire understanding of as-is and to-be process, and therefore whatever that goes behind it. I'll not get you into too many details on it, but the second big piece that we are making sure is getting incorporated is the other piece, which is to do with making sure that we have also done it module-wise so that we do it in a phased manner rather than boiling the entire ocean. So what we will be doing is the first piece that will go live from 9 months from now approximately is going to be only the finance module. Right, so the operations, etc., so we don't boil the entire ocean all over, while the subsequent modules, as we gain confidence and stability in the previous one, will cascade immediately afterwards. But it's enough to catch hold of any issues whatsoever. We don't anticipate anything, and obviously we have engaged consultants, etc., to work with us even better this time.
Okay. And is it fair to say that this other expenditure run rate, which is now at about 180 odd crores or 700 crores on an annualized basis versus maybe 500 crores pre-COVID, is it primarily on account of these modules getting implemented? Is there a one-time element over here, or how should we read into that?
Other expenditure is a bunch of many things. Yeah. Which level you want to repeat? Yeah.
Yes, so the other expenses includes quite a few things which are included in it, which is the legal and professional cost. You also have the technical services agreements, the royalties which go into this. Marketing expenditure is included in this. The rent cost is included in this. So more or less, these are all the expenses with bunch. There is no one-off others which we did in the last quarter. Other than that, it's more or less normalized expenses.
No, so the reason I'm asking is because the run rate has increased significantly versus pre-COVID. So what is it that we are doing different in this other expenditure?
Yes, so run rate has increased because during COVID time, pre-COVID, we had certain kind of concessions which we had taken in terms of rentals, which has been normalized now. And
I'm referring to pre-COVID period, before the rental concessions came into play.
The occupancy cost probably is one of them. Marketing cost has gone up also pre-COVID if you compare it.
Right.
And
so I think there are two large pieces that are there in this. One is basically the entire piece on IT, and there are multiple platforms of IT that are getting into this. One is the entire engine that we have created for our e-commerce engine, right, and which was almost absent pre-COVID. The second two are the large projects which are ERP and HPM, but a few other smaller ones. So that's one big piece. The other one is marketing, which I have spoken about. We will want to make sure that we keep plugging and investing behind marketing, and that is something that is structurally would continue going up. Obviously, should not be very varying in the long range versus turnover, but these are the two large items. Some of them are related to turnover, so hush puppies in terms of royalty, etc., which are more related to certain category sales, etc.
Okay, sir. I'll come back in the queue. Thank you very much, and all the best.
Thank you, Bhargav.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. So my first question, is with regards to if we compare the store expansion, versus the pre-COVID level till now, the store expansion, roughly has been in the range of around 19 to 20%. However, if we compare the sales likewise during the same period, the sales has just increased by 8%. So which clearly shows, a drag in terms of the sales, in terms of the per store basis or whichever way you want to look at it. If you can help us out, which particular segments are getting impacted and which particular categories are getting impacted, and are these structural impacts, or once the situation normalizes, do we hope to get them normalized?
Yeah, no, sure, Gaurav. So couple of things, right? One is that when you see store expansion, our COCO stores, which are on average giving us turnovers in the range of about 1.7 to 2 crores now, right, have actually still not, while we have stopped declining on them, which is a COVID effect, but we have still not significantly added versus pre-COVID levels. So it's a wrong comparison from that perspective. Obviously, it is, I can't blame you for it. I am sharing that information. The piece that has seen the expansion, and which is what I have been emphasizing on in the long run, is going to be extremely beneficial and capital efficient, is going to be the franchise stores. And that is where you see a lot of addition. Most of these by default are in smaller cohorts, but give us long-term access as well as brand equity building in those cohorts, whether it's mostly in tier 3 to tier 5 towns. And that is where we see, from a consumer perspective, productivity per store of roughly around 50% of where our COCO stores are at about 1 crore. What we realize as turnover, right, is about 65% of it. So that is where, the reported financial number will be, while obviously the absolute profit that we earn per pair still is comparable, or in fact even better, as I mentioned, in franchise. So that's where the big difference lies in your inference versus this. As I mentioned, however, the COCO stores will expand. It is something that we have also been a little more circumspect because of the COVID period. But last 2 quarters, as you would deduce from the numbers, our reductions have obviously eliminated. And going forward, we should see a decent amount of addition in the range of about 10 to 12 stores in COCO alone, but broadly in the range of about 20-80 ratio between retail and COCO and franchise.
Sure. So just one follow-up. Yeah, so that pretty much, clarifies a lot of things. So just one clarification that I request here. If you mentioned, that only one COCO store was added during the quarter, so there were also store closures also during this quarter in COCO?
Absolutely. We added. I don't handily have it. We added about 12, 14 stores this quarter, but we also closed many unprofitable or smaller stores, or maybe converted them to franchise, but largely closed them, right? Which is to the extent, therefore, net addition is 1. But we should not see that, these are temporal things that we do when we do analysis of stores in terms of this thing. But broadly, yeah, I've got the accurate number here. The additions are basically 18, the closures are 17.
Sure, sir. And just one more question, with regards to this, as you mentioned, while the contribution from the franchisee stores is 50% lower, however, on a profitability basis, they are in fact better or, in par with the COCO stores. So just one follow-up here, because if we see in terms of the margins also versus the pre-COVID levels, while I understand the impact will be higher on the margins, and the margins have declined by around 500 bips, but when I see the EBITDA margins, it's actually declined by around 850 bips. So, which is the part where we are missing, why the flow through from the franchisees not translating into the EBITDA levels?
Okay, couple of things, right? And I'll also request Sheval to add in. Couple of things on this front, right? One is that there is a significant impact of inflation as well as GST, which I mentioned earlier. GST for 1,000 rupees, etc. You all are aware of it. That impacted for us from a 50% of the portfolio perspective. And while we took commensurate action, etc., we had to also ensure that we remained in line with consumer trends, so in a balanced manner. And that is basically now hopefully ironing out, and we should see benefits of that flowing through, as I mentioned, at least on the material inflation. And GST now gets cycled into the base. That's one big piece that will be a differential versus, let's say, a period 3 years back. On the franchise piece, they are absolute profitable, right? But however, we need to take into account the fact that basically there is a certain amount of impact that we are carrying through inflation as well as this that we had to balance out on. So as we continue gaining scale and get turnover significantly ahead of pre-COVID levels, we will see that flowing through into our thing. Yeah, Sheval, you can also add it.
Yeah, plus, what also has happened, if you compare it with the pre-COVID levels, we have been investing quite a bit on the digital side of our business, where the channel mix is also evolving and undergoing a change. And when you see the profitability in, other than the retail, where the profitability is much lower. So that is also impacting the overall margins at the operating level.
So if I understand then in the inference that, while we are making investments in terms of many things right now, so when the scale comes back, you will see the profitability also reverting back to the pre-COVID levels. Is that understanding right?
So basically, just to expand it further, yes, your understanding is right. The question, some of them, so just to give you an example, let's say the entire piece on Bata.in is just one example, right? There is a significant investment in creating a platform as well as an engine, as well as the kind of capabilities that are required to service consumer online. But now that has to get appropriated or amortized over a certain size of turnover. That is now gaining scale. As we iron out kinks, make sure that the consumer experience is matched up to what they are expecting in general across various e-commerce platforms, that turnover scale will start flowing into the bottom line. So yes, it is an investment for the future, but right now it is as Sheval said, diluting.
So one last question, if I may just ask here. So while we have seen as per the previous participant, that the quarterly run rate has significantly increased because of the investments that we are doing right now. But do you expect these levels to sustain, or it will moderate going ahead in the coming years?
So we obviously measure for productivity, while investment can be for a certain gestation period, but eventually they do have to be measured and hopefully delivered against the productivity. Therefore, percentage productivity is something that we will want to aggressively improve upon.
Yeah, plus I think these investments we've been doing now for the last 2 years, and we would like to actually continue for some time, because as Gunjan said in the beginning, that like for instance ERP, we are taking in modules. So if the phase 1 gets over, then we'll get into the phase 2 and phase 3 to get across all the functions which will get covered under the ERP. Similarly, for other areas of digitization, we would continue to invest in that.
Sure, sir. Thank you for answering my questions, and that's all from me.
Thank you. Before we move to the next question, a reminder to the participant, anyone who wishes to ask a question may press star and one. The next question is line of Mr. Samrat Jadhav from Prosperity Wealth Advisors. Please go ahead.
Hi. Hi, good afternoon. So my simple question is,
hello. Yeah, your voice is not very clear. It's very scrambled. Yeah.
Yeah, now is it?
Yes. Yeah. Thank you.
Yeah. Okay, great. So my simple question is that how many stores are we planning to add in JF? And specifically, are we focusing on lower tier towns or all across?
So as I mentioned, roughly, so last year we would have added, basically about 120 odd stores, right?
That's including franchise.
Right. This year we would be wanting to have a little more aggressive number, but broadly in the ballpark of about 170 in, as I said, 20-80 ratio between FOCO and franchise. You see, it's also dependent on making sure that we see the right opportunity and it's the right kind of a balance between the location, the commercials, etc. So we are not fixated on it. We don't have a limitation in terms of how many, but that's the broad target that we have started off this year with, or next year.
Okay. And any new product addition which we have done or we are focusing on?
Sorry, what is that question?
Any new product addition which we are focusing on? Because I think in the entire thing we have heard more about sneakers only. So are we focusing only on that or we have added some new products also?
I just mentioned that when I made my presentation, Samrat, that basically floats has been a big addition. A large part of the effort that is there is always towards, and that was a big priority, especially for the last about 6-8 months as we got out of COVID, that we wanted to refresh our entire portfolio to our consumers, etc. There is a significant shift that we have done. We can see acknowledgement of it from the consumers. From a new product perspective, floats has been a big addition. I think the big priority is towards making sure that that gets penetrated and obviously significantly enhanced. We are investing in molds, in the kind of capability that's required so that we get even better collection going. Some of those images we have tried to put up in the investor deck, but a lot broader. The third piece that was, I think, the activity and a project that we had started just before COVID hit us was the entire piece on apparel, and that's a project that we are working on. We will hopefully have an update for you next quarter as we progress on that project. But we plan to go live on it in H2.
Great. Last question. The Vision 500 for franchisees is for till what year?
So we had started off that with a 3-year planning of traction, etc. that we have seen, and obviously the kind of capability that we have built up in terms of managing a different business model as well as running it efficiently. We hope to see it earlier than sooner rather than later. Hopefully before this next, hopefully the next calendar year ends before that. So we had started off with a 3-year plan. I think in about 2 years, 2 months or 2 years, 3 months, we should get done with it, hopefully.
Great. Fantastic. Thank you. Thanks. Best of luck for the next quarter.
Thank you. A reminder to the participant, anyone who wishes to ask a question may press star and one. The next question is from the line of Mr. Ali Shakir from Motilal Oswal Financial Service Limited. Please go ahead.
Yeah, thanks for the opportunity. Few questions. First on the revenue. So you mentioned that about 22% of our business comes from products below 500 rupee, which is where we've seen sluggish demand. Can you just share, what categories would this be? I'm just trying to understand, will this be mostly open footwear and probably even school footwear? Just trying to understand if it's only industry impact or we have also premiumized our portfolio because of which some of the lower end of the category has been more impacted.
Okay, that's actually a lot of questions within that one question, Ali. but we'll try and see if we can address that, right? So one is that a large part of it by default, right? While I had given a commentary on below 1,000, right? But even 500 remains the same commentary. So large part of the below 500 would be open footwear by default, right? I don't think we've got closed shoes there are too many articles that are there, right, in that range. The piece that is to do with that is that they got disproportionately impacted because of both material price inflation as well as in terms of the GST impact. So some of it, not all of it, right? We had to take up prices, etc., and that would have had its impact. There is some kind of a category construct that we also keep observing, which is also showing a similar kind of an impact. We are hopeful as we cycle and things normalize, we should see that coming back. On that front. Simultaneously, our premiumization strategy continues. So that is independent of this. So while we do want to penetrate down pop strata, etc., franchise, multi-brand outlets, even digital does help us, and that will keep expanding us in terms of these categories and the volumes that we get from it. But our premiumization in general from a same store perspective, that objective will continue, and which is to get in a better value proposition to consumers, better styles, and obviously the categories that we can ride on. Some of them I mentioned in my presentation.
Understood. This is very helpful. Just quick follow-up here. So is school footwear also a category that is being sluggish? I mean, any factor around there?
No, so yeah, you mentioned that school piece. School is not such a big thing from a last quarter perspective for our business. Right, schools does have a large impact between March to June, right? Broadly, while it sells throughout the year, etc., but there is a spike that happens during that time, largely to do with academic year change, etc. What I had mentioned, especially in the last quarter, was that this year, while we saw school bounce back, I don't think it's a pricing phenomenon, etc. We did see a big shift in the kind of portfolio of school shoes that were being demanded by consumers. And we were caught a little unaware, especially coming out of COVID and the kind of recency trends not available in a normal year we would have. This time, obviously, we are much better prepared. We are far more confident. And just to give you a flavor, the sporty kind of school shoes is now gaining much more favor compared to a little more traditional kind of shoes that were there earlier with the buckles and stuff like that. And therefore, that is what we are now obviously expanded our range towards, and we are very optimistic of the coming school season. From a last quarter perspective, school is not such a big phenomenon.
Understood. Second question on your margins. So, your gross margins now I think we are at a stable quarter. But despite that, if I compare with pre-COVID, we are almost 500 bp down, despite entire premiumization narrative as well. So is it that, we have not fully passed on the raw material increase that you just spoke about, and maybe, this will only revive as we see softening of raw material prices, or you think there is, proof here in the next few quarters irrespective of
So it's a combination of at least previous two questions that were discussed, right? One is the point that you made, which is that, and which I had also commented on, which is that for the mass price items, while we did take up price increases, right, the kind of inflation clubbed with GST, there was some amount of impact on margins that we had there, right, which will iron out hopefully as time goes forward. The second piece is also channel mix, right? So in some of the growth channels, etc., they are a different business model. So for example, franchise, my gross margin line takes a compromise, but at an EBITDA level, I still more than make up for it. So that comment we had discussed on that time. And some of the other new channels where we are investing in, as we gain scale, while the gross margin line will show some amount of impact, but at an EBITDA level, it comes back to us.
Okay, so the EBITDA margin, as you mentioned previously, should over time come back to the previous pre-COVID level, but it's not going to be very quickly, I understand. I mean, as we gain scale, it may happen. Right?
Thank you. Yeah.
Okay. Just last one question, if I can, add in. We are growing quite aggressively in the sneaker category, which is a very large category on online. So just want to, understand our strategy in terms of online and, what is the contribution today coming specifically from sneaker?
Okay. So that's a couple of things, right? So one is that as we have continued on the sneaker journey, it has also given us a lot of learnings, and that is in many ways, right? From back end to front end to consumer to designs to price points, and which brand do we want to promote. Some of them we have already actioned and leveraged upon, which is giving us results. Some of them we still have to do because they take a slightly more longer term lead time, especially the brand piece, etc. The piece on online, so that's showing up now. Sneakers, let's say till about a year back, was slightly dilutive on gross margin compared to the rest of the portfolio. Now it has started becoming accretive. That comes with scale, that comes with better understanding of product and pricing profile, etc. The piece on online does lead sneakers. It is at least about 500 basis points contribution higher. And within that, Bata.in, as I mentioned, is almost 1/3 of our sales comes from sneakers. So on a puritanically basis, I mean, I keep asking the team that if we can do that on Bata.in, why don't we do it in our stores? So it's a question of hopefully getting some of the other pillars into the place to keep going on that journey.
Got it. This is helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Mr. Gaurav Jogani. Please go ahead.
Thank you for the follow-up, sir. So my one question is with regards to the distribution business. We have taken a lot of expansion in terms of the town coverage and also in terms of the weighted distribution that we are doing. If you can throw some light how this has improved versus the pre-COVID levels now, and how the contribution has increased for us in the overall scheme of business.
Right. So a few numbers, Gaurav. It is growing significantly higher. I would say almost 30% plus versus pre-COVID. We are also seeing now it contributes to roughly around 14 to 15% of our turnover. This would have been about 11% or so, let's say, pre-COVID. More importantly, there we have also seen on an overall basis, while for the, let's say, 9 months of this fiscal year, we have significantly outpaced whatever we track as market category growths. Right. Last quarter, where actually some amount of pressure was seen September onwards, there has been some relaxation in terms of credit periods as well as discounts in the market. We have refrained from it as prudent. While it has given us some amount of short-term pressure, I feel it will also help us bounce back much faster as things normalize in the future. So does that answer your question?
Sure. That helps, sir. And so just one more on the part of the the cost savings measures that you've been highlighting, in terms of getting the supply chain right, also in terms of the flexi manpower that you have adopted, plus getting better near to the sourcing areas also. So if you can help us quantify what kind of savings these have generated for us over the last say couple of years or whatever time frame that you want to allude to.
That's a question that I have also for my team, Gaurav. But let me try and see how best I can address it, right? See, the last 2 years, obviously we saw savings during COVID, etc. I'm not going to repeat all of that, but those were mostly one-off. There were some structural ones in terms of unprofitable stores, etc., and that's some of it is a continuous exercise that you keep weaning out as time goes by. The pieces that have been harping upon, and hopefully I will give you a lot more updates going forward, I'll touch upon a few of them. So flexi manpower, I've talked about it. It allows me to basically have the right kind of manpower as per footfall profiles, and therefore build in much better efficiency while delivering better service to consumers. That is now contributing to 15%. That was close to or less than 3% pre-COVID. That will show up as as SSG keeps going up in terms of percentage to turnover and therefore productivity of that cost line item. The second piece is in terms of 3PL, right? We have taken our largest warehouse that handles roughly around 40% of our volumes to 3PL. That will show up in terms of not only immediate benefits in the next, let's say, 12 months, but structural benefits over multiple quarters and years, right? In terms of managing that much more efficiently and expanding the entire 3PL across several other warehouses of ours. Right, so that is one big lever that should start impacting. There are pieces to do with, let's say, freight, etc. We do see the view on that, and there is a lot of work and action that is being worked upon, and we will talk to you about concrete issues on that front. We will also want to ensure that we have started seeing immediate benefits on certain other cost lines which are fixed costs in our in-house manufacturing. The VRS that we ran last quarter will also give us, but some other goes also on the fixed cost side in terms of the manufacturing piece. And last but not the least is also in terms of material prices, etc. As we see those trends much better, we will want to make sure that flows into our margins also as time goes by.
Yeah.
Yeah.
And just to add, we are, doing a lot of savings in various kind of areas. At the same time, we are also investing quite a bit of money in our technology. We are investing quite a bit of money in marketing in order to make sure that, we also ramp up in the areas where we want to ramp up. In the digitization also, we are investing a lot of money. So, that's how we are balancing the overall cost also of the organization.
Sure, sir. That's helpful. Thank you, and that's all from me.
Thank you. The next question is from the line of Mr. Girish Pai from Nirmal Bang. Please go ahead.
Yeah, thank you for the opportunity. You've grown sales by 18.5% in the 3Q of FY23 versus the 3Q quarter of FY20. How much is that contributed by volume?
Okay. So basically, hi Girish, by the way. So basically, we've seen, as I said, basically some amount of demand sluggishness in this quarter from those price point perspective. So volumes have been muted comparatively. While we grew by volumes by almost 7% in September quarter, this quarter has been about -5%. So broadly, we would be at around positive 2-3% versus pre-COVID, let's say July to December.
Okay. And I go back to the discussion around the other expenses. It used to be about 16% of sales in 3Q FY20. Today, or rather in 3Q FY23, it's 20%. The bridge of these 400 basis points, how much of that has been contributed by higher tech expenses and royalty and also marketing spend, like ad spend to sales ratio? How much has that increased by between the 3Q pre-COVID and 3Q now? And similarly, tech expenses or digitization expenses, what was it in the pre-pandemic phase and what is it now?
Okay, so that's a pretty detailed question, Girish. Broadly, between the three, it accounts for 90% of it. What we will try and do is maybe we can offline try and revert back on the exact contribution between the three. I'm sure we can share that with you. That's not a problem.
Yeah.
Okay. Lastly, did I hear you say something that you got some ambitions on the apparel side, and how large are those ambitions? Like, you want apparel to become what percentage of your turnover, say 3 years down the road? Or did I hear you right in the first place?
No, you heard me right, that we are, so there's a little context to this. We had started a certain amount of project on this. It's an area that we will have to make sure that we get our act right. Right. It is a very adjacent area from a consumer shopping perspective, and therefore it's, how do you say, is an adjacent leverage that we can do with our, retail network, etc. So that's what attracts us, because besides the fact that it's a very large and a fast-growing profit pool, both in terms of revenues as well as obviously profitability. So that is what attracts us. Concrete plans on this, etc., we will get back to you. But the reason that we are even talking and putting effort, we have developed an exclusive team behind this, is because we see a material impact if we are able to do this well over a period of time.
Okay. Thank you very much.
Thank you, Girish.
Thank you. The next question is from the line of Mr. Shubham Thorat from Perpetual Investment Advisors. Please go ahead.
Hi, Shubham.
Mr. Shubham, your line is unmuted. Please go ahead. Mr. Shubham, please unmute your line and proceed with your question.
Hello, can you hear me now?
Yes.
Yeah. Hello, sir. So just one question from my end. Before that, one clarification. So I just missed your initial remarks on ASP front. So if you can reiterate on that bit, and if you can comment on the average ASP for your portfolio for this quarter.
Okay. So both the questions are related to ASP. So Shubham, ASP is for the overall portfolio sits at about 770 rupees. Just 2 seconds. Yeah, 772 for the quarter. It is sequentially as well as versus last year up by about 13%. However, unlike let's say the first half of this year, it has all been driven by premiumization and no sequential price increases that we have taken. Does that answer your question?
Yeah. Yes, sir. And my second question would be that on the that you mentioned that the material cost inflation and the GST impact has been quite severely impacted your mass portfolio, and you had mentioned in your presentation that the material cost is continuously coming down right now. So how do you think it will affect that mass portfolio, and when do you think the demand in that category would return back?
We can't give forward-looking statements. Some of it is some of this is extrapolating the future, which we are not, which we'll wait and watch. But however, on the material price sense, right, there is some amount of stability, and in certain categories like, basically PU as well as EVA, we do see, and even rubber, we do see some amount of decline. So that obviously should aid if that sustains, but it's early signs. So let's keep our fingers crossed on that front.
Okay, great, sir. Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Mr. Vikas Jain from Equirus Securities. Please go ahead.
Thank you so much, sir, for the opportunity. So just continuing with the last question, you said that there has been some decline in the key raw material that we consume. Was there an impact on the gross margins coming from consumption of water? And is there any further high price inventory there into the system which might have some impact going ahead as well?
We can't quantify that. However, it is these 2 or 3 materials that I have mentioned have seen some signs of decline. We will have to wait and watch how that pans out over, let's say, a slightly more extended period of time, because then it makes impact both from a refresh of our cost perspective as well as from a scale perspective once it spreads across a significant part of our portfolio from a FG cost perspective. So we'll have to wait and watch on it, but right now at least the inflationary upward curve seems to have flattened out. So that's at least encouraging for us.
Sure. And just with respect to a strategy perspective, if the price decline in the raw materials continue, would there be some pass on to the consumers to boost the demand where we are seeing the pressure that is the mass category?
Okay. We basically will, we will have to evaluate this as on a case-by-case basis, right? As I have said, our premiumization strategy will continue, but on a case-by-case basis where we see benefits of obviously competitiveness and competitor actions also, we will evaluate those. So it will be difficult for me to comment immediately on it.
Sure, sir. Sure. And just one last question. Just from where do you see our business probably in FY24 and 25 onwards as to like if things normalize, where do we see a business with the extended network and the franchisees and all that we're opening? Where do you see a growth on an annual perspective is the number that we can achieve in FY24 and 25? Any broad numbers would also do.
We don't give forward-looking statements. We do have a strategy which is over 3 years as well as 5 years. We seem to be on track on it.
both not only from a numbers perspective, but more importantly, even from a lever as well as some of the investments that we have talked about, because they will fuel future growth. We definitely want to get back to pre-COVID CAGRs and maybe even higher.
Sure. Thank you so much.
Thank you. In the interest of time, we will take this as a last question. I now hand the conference over to Ms. Nikita Jain for the closing comments.
Thank you, Yusuf. Thank you, management. Thank you, participants, for taking the time off and joining the call. Have a good day.
Thank you. On behalf of Batliwala and Karani Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.
Thank you. Thank you, everyone. Thank you.